The smash already happened. Gold ripped higher, then it got yanked, hard, from the highs, dropping from the mid-5,000s into the 4,000s. Silver didn't cool off. It got body slammed, falling so fast it felt like the floor disappeared. And now the loudest voices on your feed are chanting one word: sell. Here's what happened, clearly. A leveraged metal rally met a forced unwind. Paper markets puked contracts, headlines turned into weapons, and the crowd got pushed toward the same exit at the same time, right when the biggest buyers on earth prefer you terrified and liquidating. Welcome back. If you value straight talk with zero fluff, subscribe, because the next leg of this story won't come with warnings. Now listen, if you bought gold above 5,000 or silver above 90 and you're staring at red numbers, I'm not going to sugarcoat it. It hurts. It's the kind of hurt that sits in your chest, not just your account. You open the app, you see the drawdown, and your brain starts bargaining. Maybe I should just get out and stop the bleeding. That feeling is real. But it is also the exact moment markets are designed to exploit. Because crashes don't just move price, they move ownership. When weak hands panic, strong hands get paid. And the question you need to answer right now is not, did metals fall? They did. The question is, did anything fundamental break? Or did the market just run the classic playbook to pry metal out of your grip? That's what we're going to do today. No hype, no blind optimism, no doom porn either. We're going to take the information you already have, zoom out, and rebuild context, fast. And at the end, you'll have a cleaner decision. Hold, add, hedge, or exit. Not because a guru yelled at you, because the structure of the situation makes sense. Let's start with the trap. After a violent drop, the internet pretends certainty. Bubble popped. Game over. You're stupid. Those are not analyses. Those are emotional scripts meant to trigger one outcome: capitulation. Because capitulation is profitable for someone else. And here's the uncomfortable part. Some of the people telling you to sell are not trying to help you. They're trying to position themselves. They want your liquidity. They want your metal. They want your shares. They want the rebound without the pain. So before you do anything, you need one piece of mental armor. Price is not truth. Price is a vote, often a panicked vote, at a specific moment in time. Now I'm going to give you two historical punches in the face because history doesn't repeat perfectly, but it rhymes violently. 2008, gold drops roughly a third. Headlines declare the safe haven dead. People dump it in disgust. Then the same decade turns into one of the strongest gold runs of modern times. 2020, silver gets smashed into the low teens. Fear everywhere. Industrial demand will die. Then the rebound comes so fast it feels unreal, if you held. This is not a guarantee that today will mirror those events. It's not. Maybe the decline continues, maybe gold digs lower, maybe silver retests levels you don't want to see. But if you sell purely because the crowd got loud, you're playing the same losing game millions played before you. So what do we do instead? We check the environment. Because metals don't move in isolation. They move as a response to the broader financial system's stress. And right now, the broader system is screaming in a language most people ignore. Let's talk about the stock market. Not because you came here for stocks, but because stocks are the mirror that tells you when fear will rotate. There's a metric that measures how expensive stocks are relative to underlying earnings. Call it valuation pressure. The details don't matter. The signal does. That signal is near extremes that historically only show up right before major regime shifts. Two infamous eras sit up there, the late 1920s and the dot-com peak around 2000. You know what happened after both. And you know what else happened after both? Money ran for safety. Not safety as a marketing word. Safety as in assets without counterparty risk. Assets that can't be defaulted on by a spreadsheet. That's where gold thrives. So when someone mocks you for holding gold because it dipped from the highs, ask yourself a sharper question. Why are they not equally terrified of owning the most expensive equity market in generations? Why are they obsessed with your metal and not with the valuation cliff under their portfolio? That mismatch is a clue. Now let's bring in the geopolitical engine, because this is where the story stops being trader drama and starts being reserve strategy. Major nations have been quietly reshuffling the plumbing of global finance for years. Some are reducing exposure to U.S. government debt. Some are signaling discomfort with long-term bond risk. And when a big player starts treating US debt as less of a sacred safe haven, it matters. Because when the perceived safety of one asset slips, something else absorbs the demand. Historically, that something else is not a meme. It is not a trend. It's not a new coin. It's the oldest reserve asset in recorded history: gold. Now you might say, okay, macro is messy, but what about my entry? I bought too high. Good. Now we're talking about what actually matters. Entry matters enormously. If you buy a move that's already extended, a pullback feels like betrayal. But pullbacks are normal in bull markets. They're not a bug. They're the function that resets leverage and clears weak hands. So instead of asking, am I ruined? Ask, where are the levels where real buyers show up? Because in crashes, you learn where the market is truly supported. In this drop, gold didn't just drift lower for months. It hit a zone and snapped back quickly, fast enough to signal that serious demand was waiting. Not retail hope, real money demand. That kind of bounce does not come from comment sections. It comes from balance sheets. And here's why that matters. A fast bounce means the market is mapping the battlefield. It's telling you, below this, bids show up. Now, could those bids fail later? Yes. Markets can break support. Nothing is invincible. But ignoring the speed and violence of a bounce is how people miss the signal and then chase the next rip higher. So you don't need certainty, you need structure. Here's the structure. After a blow-off and a smash, the market often coils. Volatility compresses. Buyers and sellers battle. Then it breaks, one way or the other. And when it breaks, it usually breaks hard. That's the first cliffhanger. We are likely entering a decision zone where gold chooses the next regime, continuation or deeper reset. Now let's talk about the metal that tests your soul: silver. Silver is not gold's calm cousin. Silver is the unhinged sibling that laughs while jumping off a roof. When silver runs, it runs like a rumor. When it falls like a trap door. And this is why silver hurts people. Not because the thesis is always wrong, because the path is violent. So what do you look at when silver collapses? You look for the split between paper and physical. Because paper can be dumped in an instant. Physical can't. Physical requires bars, delivery, borrowing, leasing, transportation, vaulting. And during panics, that physical side tells you whether the crash is cleansing froth or exposing scarcity. Here are the kinds of signals that matter in a silver crash. Borrowing stress, when it gets expensive to borrow real metal. Delivery demand, when large amounts of metal are being pulled for settlement instead of rolled as paper. ETF turnover, when trading volume explodes so hard it reveals a war happening under the chart. If those things spike while price is collapsing, that is not a dying market. That is a contested market. That is a market where someone is slamming paper to force selling, while someone else is grabbing physical with both hands. And this is where most people get tricked. They stare at the red candle and assume demand vanished. But the physical signals can be shouting the opposite. Paper says, silver is trash. Physical says, give me the metal. So which do you trust? I'll tell you the rule. In a real squeeze, the truth lives in the hardest place to fake: physical availability and borrowing stress. Not in the most liquid place to spoof: paper. That's not conspiracy, that's mechanics. Now let's address the thing you're thinking but maybe not saying out loud. What if this keeps falling and I get obliterated? Fair. Let's be adults. There are real risks. If liquidity tightens globally, everything can get sold. Metals can get sold, even if they're the long-term hedge, because margin calls don't care about your thesis. If policy shifts hard, if rates surprise, if risk assets dump violently, you can see another wave of forced selling. So I'm not here to promise a straight line up. I'm here to tell you that the people screaming "sell now or die" are usually loudest at the exact point where risk and reward begin to flip. Because after a big drop, the next question is not, how far did it fall? The next question is, what does it do next? Does it stabilize while physical demand stays firm? Does it retest key zones and hold? Does it reclaim levels that were broken during the smash? Those are the tells. Not your feelings, not their headlines. Now let's pull the camera back even farther and look at the currency reality, because this is the heart of why metals exist. Here's a simple mental experiment that changes how you see everything. Instead of pricing gold in dollars, price dollars in gold. Ask, how much gold does $1 buy today, compared to decades ago? Then zoom out. You see the same brutal staircase. The dollar periodically rallies, gold dips, people celebrate strong dollar, then the dollar fades again and gold makes new highs. It's not a one-year trend. It's an era trend. And over long periods, the purchasing power of the currency bleeds. That doesn't mean the dollar collapses tomorrow. It means the system's default setting is depreciation. Which means every time the market gives you a violent discount on hard assets, the question becomes, is this a reversal of the long trend or another step on the staircase? If you've watched that staircase for long enough, you know the answer has usually been the second. Now I want to talk about miners because a lot of you aren't just holding metal, you're holding the leverage. Mining stocks amplify everything. They amplify upside, they amplify pain, they amplify your emotions. And in this crash, miners likely felt like getting hit twice, once by the metal dropping, and again by the market punishing risk. That's normal. But here's what matters in miners: relative performance over long windows. There are periods where miners underperform for years. It's brutal. It grinds you down. It makes you swear you'll never touch them again. And then, when the cycle flips, miners can outperform metal for years. Not days, years. That rotation often starts quietly, and it often starts when the crowd has been traumatized and refuses to believe a rebound is possible. That's the second cliffhanger. Miners don't need perfect metals. They need margins, sentiment, and a regime shift where capital flows back into the sector. And those shifts often begin right after pain peaks. Now we have to address the title idea. They want you to sell. Who is they? It doesn't need to be a shadow club in a bunker. It can be something simpler: market structure. In a leveraged market, forced selling creates bargains. Bargains attract capital. Capital needs inventory. Inventory comes from you when you panic. Exchanges raise margin. Liquidations cascade. Price drops. Fear spikes. Retail sells. Institutions buy. That's not a theory. That's the cycle. And if you don't believe it, look at who has the ability to buy when everyone else is being forced to sell. It's not the average person. It's the players with deep pockets and long horizons. So, yes, the market wants you to sell in the same way a vacuum wants air. The system pulls inventory from the weakest holders. Now the real question becomes, what do you do practically? Here's a framework that avoids emotional decisions. Step 1. Define your time horizon. If you need the money in the next 6 months, you're not investing, you're gambling. Metals volatility will eat you alive. If your horizon is years, volatility is the price of admission. Step 2. Define your risk limits. If a further drop would break you financially or mentally, reduce exposure. Not because a guru told you, because you can't hold through the path. There's no shame in that. The market doesn't pay you for bravado, it pays you for survival. Step 3. Watch the tells. For gold, does it defend the key bounce zone? Does it reclaim broken levels? Does it form a base? For silver, do physical stress signals stay elevated? Do deliveries stay strong? Do premiums stay stubborn even when paper dips? Because those are the places where the narrative breaks. If paper price says collapse, but physical pricing says scarcity, that's a mismatch that usually resolves with price moving back toward reality. Step 4. Stop outsourcing your conviction. If you bought metals because you believe in currency debasement, deficits, reserve shifts, and geopolitical stress, ask yourself honestly, did any of those pillars disappear in the last 2 weeks? Or did price simply flush leverage? Most of the time it's the second. And that's why this moment can be an opportunity. Not a guaranteed one, an asymmetric one. Now I want to make this engaging for you, not preachy. So let me ask you 2 questions. Answer them in the comments because I read them and it helps everyone think clearer. First, what did you buy and what level made you feel the most fear? Name the number. That number is usually where the market is trying to rewire your brain. Second, are you reacting to price or are you reacting to your original thesis? If your thesis is intact, why is your action changing? Those questions aren't traps, they're mirrors. Now let me give you the blunt truth most people avoid. If you bought the top, you may have to endure time. Not because you're doomed, because markets punish impatience. The people who get rich in cycles are not always the smartest. They are the ones who can sit through volatility without self-destructing. And the people who lose are often the ones who were right, but couldn't hold long enough to get paid. That's why the system loves crashes. Crashes don't just transfer money, they transfer conviction. So here's the last part, the part that matters most. If the bull case for metals is real, this sell-off is not the end. It's the reset before the next leg. If the bull case is fake, this sell-off is the beginning of a longer unwind. How do you tell which is which? You don't guess. You watch. You watch whether gold stabilizes and is accumulated on dips. You watch whether silver's physical stress remains while paper gets shoved around. You watch whether risk assets start to wobble under extreme valuation pressure, pushing capital back into safety. You watch whether big buyers keep behaving like this is a long-term shift, not a short-term trade. And you make decisions that match your horizon, not your fear. Because fear is expensive. Fear sells bottoms. Fear buys tops. Fear makes you pay tuition to the market over and over again. So if you're sitting there right now with that heavy feeling, here's your permission slip. You don't have to decide today. You just have to stop making decisions under attack. Take a breath. Zoom out. Write your plan. If your plan says, I can't handle this, reduce risk and live to fight another day. If your plan says, my thesis is intact, then stop letting headlines rent space in your head. Because the worst outcome is not being wrong. The worst outcome is being right and selling anyway. If you got value from this, hit subscribe. Short, simple, and it helps you not miss the next update when the chart makes its next violent decision. And drop your answer to those 2 questions in the comments. I want to know what level shook you. And I want to know what you're doing next. Hold, add, hedge, or exit. And one more thing. The next move will probably not be gentle. After this kind of flush, markets love to whipsaw. Up hard, down hard, then up again. Just enough to exhaust you. That's the psychological warfare. If you can't stop checking the chart, you'll get shaken out by noise. So watch the signals, not the candles. The candle is the trap. The signal is the map. Now the real game begins.